get a move on, and joining us live right now we have Sandip Sabharwal. Hi Sandeep, although there may be two holidays this week, it is a pretty critical one. You have that surprise move by OPEC, RBI policy, the Q4 banking updates, and of course reports trickling in on the IT previews. What is it that you'd like to start off with?
Yes, I think the end of March was ended well for most of the global markets as people looked through the entire banking crisis that sort of played out at the beginning of the year, beginning of the month. So things seem to have stabilized. Like you rightly said, that the OPEC move has created an upward move in oil prices in the near term. So I think that could slow down the move of the markets for a few days. But I think directionally, markets are pretty well placed. This should not impact the overall outlook for equities unless and until crude prices just shoot up above $100. So which is not the base case because significant surplus capacity is getting created with all these cuts. So that by itself creates a scenario where oil prices don't move up beyond a point of time. So things are reasonably placed, like you said, and IT companies obviously will start reporting first next week onwards. I think next week onwards. So that will be interesting to watch because that's where uncertainty prevails about the growth outlook for the current financial year.
But Sandeep, surprisingly, some of the mid-cap IT stocks are already sitting at their 52-week highs. We were looking at the performance of a KPIT Tech, although there is a brokerage, stating that the best is already baked in, Cyient, etc. These stocks are still in a dizzy.
KPIT had a different story going for it, and that because of their work on the EV automation side and the kind of order flows they were getting. So I think that's on a different plane, and that's why it's been one of the outliers. Some companies are more speculative, so there we don't really need to comment on too much. But as a broad theme, IT has not done well. There'll always be some exceptions. Like initially we saw something like Tata Elxsi do very well when the rest of the IT space was not doing well, and then it fell 40-50% from the top. So I think these sort of things will keep on happening. Specific companies doing specific work which is dealing from the overall IT cycle might continue to do well. So KPIT is done well. Obviously, valuations have gone up higher, so it could go through a phase of consolidation. Longer term, it should still do well.
Looking at some stocks which are above the 200 DMA, and it's like when you look at the data, you realize that the biggest gainer last financial year was ITC. Then it is Britannia. Britannia has done extremely well in last 1 year. There you go, that's ITC for you. It may not do very well now, but in last 1 year, Britannia has done exceptionally well. Nestle also had a very strong Friday. It is now above the 200 DMA. Sandeep, why are stocks like Britannia, HUL, the high flyers in last 1 year? I mean, you would imagine that these companies have got hit everywhere. Competition, commodity prices, volume growth, and lower margins.
I think the reason is very simple that despite all the headwinds, a company like Britannia has actually been able to hold on to margins. In fact, they've been able to increase it despite the huge inflation they've faced on wheat, milk, etc. Now, some part of it is also because on the wheat side, they had some hedged exposures. So next year, and now that wheat prices are possibly correcting, so they might actually ride through this thing. Milk price uptake hurts all these companies. So how the pricing power plays out there, we need to see, because the hike in milk price has been the highest in the entire food category space. So the reasons why particular companies have done well is because they have done well despite the headwinds. And whichever company has done well despite the headwinds, we've seen those stocks do really well.
Meantime, let's get in a view then, Naresh, on the charts. Just going by the kind of outperformers that we saw on Friday's trading session, can't help but notice that Reliance Industries was on top of the heap with that 4% gain. At 23.31, what are the charts indicating?
So Reliance Industries has again flipped back into that band above the 2300 zone. So if you look at the history of the stock for the last 2 years, since it topped out in September 20, the stock has been finding support around that 2180 to 2300 mark. We broke below that. We tested the lows of February 22 around 2180, and we've again bounced back. Now the critical price point for the stock is once it sustains about 2450. That would indicate a momentum shift towards the upside. So for the near term, I would expect a dash towards 2400, 2450, and that would be a stiff resistance. So at current levels, the risk reward doesn't become interesting because a little bit of a gap up and then you are very close to 2400, 2450. So at 2450, I would expect some bit of a consolidation and then take a fresh view if it can sustain about 2450.
Yeah, that's the view coming in on Reliance Industries. Meantime, Sandeep, you've also got some of those defense stocks in the spotlight today. The fact that HAL, BEL have given their order book checks and things seem to be shaping up quite firmly and quite well. What's your outlook given the fact that their order book guidance is looking strong? And for both of the companies as well, you've seen the revenue growth that's been quite healthy.
Yeah, so the defense is a durable story where these companies have been continuously getting good orders. But the only thing is that these orders tend to be very long gestation, and to that extent, people should not suddenly expect that these companies will start growing 20-30%. That's not going to happen. It's a slow and steady execution cycle that will play out. And given the fact that the visibility is there for 5-6 years, the the stocks become low volatility because of the fact that one, they don't have debt issues. Second, the orders are from the government, so to that extent there are no payment issues. And third, the execution cycle will play out. So these stocks continue to be so after the initial up move of the last 2 years. Now they are steady return stocks and should be part of portfolios.
Okay, now what did very well, I think, on Friday was Mumbai-based real estate companies. The new ready reckoner rates have not been changed, which means the stamp duty rates and the ready reckoner rates, which used as a benchmark for real estate, at least in the city of Mumbai or Maharashtra. Let me put it this way: they've not changed. There was a speculation in the market that it could be changed, but thankfully that's not been changed. What it means that's good news for Maharashtra-based real estate companies, which are some of those Maharashtra and Mumbai-based real estate companies. Lodha, also known as Macrotech Developers. You've got Kolte Patil, large land bank in Pune and in Bombay. You've got Ubroy, very large land bank concentrated in and around Bombay. Godrej, hallmark prop projects in Bombay. Sandeep, how positive is this?
So because ready reckoner rate moving up was not the expectation in any case, I think, because it's not that real estate prices have actually gone up. So real estate deals have gone up, sales are happening, but prices are more or less steady. So to that extent, I don't think that there was an expectation also that it should be going up. Overall, this year will be more interesting to see because once those tax gains, tax set off about 10 crores of profits was eliminated in the budget, we saw a lot of large ticket deals happening prior to the deadline of 31st March. And that will boost the performance of many of these companies for this quarter, which is past. But then how do these high value deals play out this financial year, especially when rates have also gone up, will be interesting to see. Overall, I would think that as a basket, real estate seems to be fairly valued.
What are you buying as a basket? I'm not talking about shopping basket, I'm talking about market basket, not about what you bought for Sohani and how are you planning to buy or summer holiday basket, but stock market basket.
So, right. So I believe that Indian banks are very well placed. So Axis Bank, ICICI Bank is something which we keep on buying continuously whenever there are opportunities. Reliance looks interesting from these levels because it's got beaten down so much for a 10-15% kind of gain. L&T will continue to do well as a steady performer. And some consumer names I think on valuations look interesting. So Bata is something which we have been accumulating because that's got beaten down. It's not recovered at all. So that gives an opportunity to buy at lower levels. So, and on the mid cap side, uh, companies like VA-Tech Webag, which has been winning good orders, and the growth outlook remains very strong. It still trades at around 10 times current year earnings with strong cash flow generation. That's something which I like.
I'm scanning through some stocks where there was a bit of a mid cap activity, and the other one, I mean, Interglobe Aviation is not mid cap, but it's not entirely large cap in terms of the market cap also. But Interglobe Aviation, it saw a breakout. It went above 200 DMA, but just because crude prices are down, will this entire space get challenged? Sandeep, I want to go back to that point on crude, and we can argue both ways. Argument number one, pure desperation by OPEC because they are losing market share. Russian oil, Russia has entered into side deals with countries like India, and the oil supply has not got disrupted. Second, they also feel that the demand is getting punctured. China is not consuming as they were expected to consume after opening up, which means OPEC in a sense is telling you a clear message that commodity prices have peaked out, demand has peaked out, and inflation will come out.
Yeah, so there was an expectation, like you rightly said, that once China opens up post its COVID restrictions, we'll see a revival in fuel demand out there. But I think first 3 months data shows that that's not really happened. And that's one of the key reasons why crude has been weak, ex of the issues around economic growth, monetary policy, etc. So both aspects are right. They are getting desperate for higher revenue in the short term because of the fact they realize that in 5-10 years, as EVs become more mainstream, the demand will only moderate instead of increasing. So they want to get as much as revenue now as possible. So the challenge for other countries is only if the crude actually goes above 90-95 and sustains there. So a 5-6% move is perfectly fine because of the fact that crude actually fell so much and reached a 15-month low last month before now reviving with these moves. So overall, let's see how it goes. It's very tough to predict crude oil prices, but it's clearly a desperate measure.